This conference will now be recorded.
Hey, welcome everyone to the Moving Markets Podcast. I am Kevin Hurley, owner of Hurley Investments, and today we have Jeffrey Dunyan, the owner of Safe Option Strategies. Jeffrey, say hi to us so we know we're good to go.
Hey, everybody, I'm ready to roll and got plenty to talk about today. Glad to be here with you, Kevin.
Well, let's hit it. Let's come right off the bat. I know we're going to talk a lot about SVB and how our banks are not helping us out a whole lot today. We're going to talk about interest rate hikes, I'm sure. Not to mention, what a wild day in the market. Let's start with that. What do you think about the stock market movement today, Jeff?
Schizophrenic is the word that comes to my mind, and I hope I'm not offending anyone that's schizophrenic. Although if I am, they'll probably forget about it in 5 minutes when they change personalities. So, yeah, I mean these numbers where it finished: Dow Jones down 90, S&P down 5 points. So those are, I would say, the Dow being down almost a third of a percent is not an insignificant move, but it's sort of kind of relatively flat. The S&P down 1,100%, almost dead flat. The Nasdaq up a half a percent or almost a half a percent is what surprised me. But it was the back and forth. It was the wild west out there. I mean, this thing was moving all over the place today. Um, and all I can say is it was a schizophrenic market. Nobody really knew what to do today.
I was watching futures and news throughout the weekend. Amazing how we took a big dump in futures Friday afternoon. It looked awful. Yet Sunday, when that term bailout came out, all of a sudden everything's okay again. And it was just shocking to see the futures really be down last night 2%, yet open up today. Makes no sense. It was ridiculous.
Kevin, I got to correct you on something because we don't want to piss off the wrong people. We cannot call it a bailout. It's an emergency backstop. Um, let's be clear on that. It's an emergency backstop because that doesn't sound like we're all getting screwed over by the Fed and by the FDIC and by our government, and that does not imply that our tax dollars are going to bail these morons out. If we call it an emergency backstop instead of a bailout, so let's
All
make
right,
sure
let's
we're
work the numbers between backstop and bailout. It was reported FDIC is providing $25 billion of liquidity for a $349 billion failed bank and a $255 billion failed bank. I know math, I know numbers. Please explain to me how $25 billion somehow bails out $600 billion that we're going to make whole for those people that invested in these banks.
yeah, well,
It's a
the answer
bailout.
the answer is simple. It's we're gonna the Fed's gonna print more money. Between the FDIC and the Fed, they're going to throw all sorts of cash at the big investors that have lost everything with this bank. They're going to bail them out because they're the biggest donors to political campaigns. They're the biggest influencers in the way of lobbyists. They're going to throw all the cash in the world, and ultimately, at when it comes right down to it, no matter how it gets spun, I'm joking around. This is just this term emergency backstop. This is just total nonsense spin. That's such a BS made up word to try and spin what's happening. It's a bailout, plain and simple. And at the end of the day, it is mine and your tax dollars and the rest of America's tax dollars that are ultimately going to pay the price in this bailout. If it's because of the Fed printing more money and the dollar not going as far, and therefore the cost of everything going up even more than it is right now, that's still our money at play, and that's still our money financing this thing. Biden just this is what I find incredible. Last week, Biden rolls out his budget and proposes massive tax hikes. I mean, these are arguably some of the biggest tax hikes ever proposed in the history of this country. And now this story gives them the perfect backdrop to push that as being needed, not just being wanted.
Agreed, but from my research, not only is it going to be taxes, but I read a really interesting article. It's kind of a one-off. No one really wants to pen their name to it, but just the thought of what fees have to be added into banking fees. Basically, the article, as they were working their numbers, they said, it's going to be next to impossible, even if interest rates come down in the future, it's going to be next to impossible for a home loan to be affordable for the middle class, because now they've got to hide fees in areas that we won't see. They're extended over longer periods of time, like home loans, 30 years that we won't notice. It's scary if you work out some of those numbers on, once again, what our government is doing to us. Just freaks me out.
So let
Stupid.
me, okay, and I mean, that kind of, I don't know. I've heard throughout the day today and over the weekend, I've heard different things. I've heard varying things on, what the cost of all this is going to be, how it's going to affect people. Kevin, I think you and I, if memory serves, you and I respectively, because we've known each other a really long time, I think we bought our first homes at similar times to each other, maybe within a couple of years. Do you remember your first home mortgage, what your rate was?
Are you talking way back in the day, like West Valley time?
Back when you and I met each other, we were working at the same place. You had your home out there. We were a couple miles away from being neighbors basically, and working at the same place. My wife and I had our little townhouse. I think we paid $90,000 for that townhouse, and with good credit, I think we had about a 7.5% interest rate.
And I was going to tell you, I thought it was like between, I was going to say seven, but I think I was just under like 6 and 7/8, right? Pretty
Okay,
close to
so
that.
ballpark in that same area. Let me ask you this. When we were buying our first homes at 7% interest rate approximately, how freaked out were we over high interest rates?
I wasn't at all, to be honest with you.
Neither was I. And one of the main reasons I wasn't freaked out is because I remembered back 20 some odd years before that, maybe 30 some odd years before that.
The
Well,
80s
no, it
and
was
high
20 something because
interest.
I wasn't
Yep.
old enough to have it have been 30 years prior. Some 20 odd years before that, I have a vague recollection of how excited my mom and dad were when they refinanced a house and got it under 15% because
I
they
was
had
going to
bought the
say high
house during
teens,
the late
right?
70s when Jimmy Carter tried his best to wreck our economy, and interest rates with good credit were above 15%, and medium credit you were probably paying 18 or 19% on a home loan.
Yeah. In fact, you want to give the little history lesson about home ownership and interest rates and who qualified, who doesn't? You want to give that a brief recap so our listeners can understand where we're coming from?
So earlier today, Kevin and I were having a conversation about what led to this situation of this bank meltdown, like what ultimately led to this. And I'll give you the real condensed version. People our age would understand if I said the Cliffs Notes version. If I say that to my kids, they look at me and say, "What the hell are Cliffs Notes?" Um, People from our generation know exactly what Cliffs Notes were. So I'll give you the condensed version. Jimmy Carter in the mid to late 70s signed legislation called the Fair Housing Act. One of the most egregious pieces of legislation that does not get talked about in the history of this country, because it basically was a law passed by Congress, signed by the president, that said no longer do you have to have good enough credit, good job history, make enough money to afford the house you want if you're a minority. That was, I mean, that's an, so I know some people would scream at me and say that's an oversimplification of it, but I'm telling you straight up, that's what the Fair Housing Act was. The government would step in and intervene on behalf of the banks so that they didn't take a loss, as long as the banks were loaning money to people who otherwise wouldn't qualify for it. Now, before anybody thinks I'm being racist about this, we're talking about people who qualified for it. I'm not talking about people who were discriminated against and could not get a loan because of their skin color. That I hate that. That's horrible. That's racist. I would never condone that. I'm talking about people who weren't making enough money, who didn't have good enough credit, who didn't have a good enough job history to go into a bank and qualify. But basically the law said if they're a minority, none of that matters anymore. It no longer matters if they can afford it. It no longer matters if they've got good credit history. It no longer matters if they've got good job history. If they check the right box for their color of skin and their ethnic background, you have to loan them the money. And the
if I
government
could throw in there, Jeffrey, or if you
what's that?
lied about what you were really making,
They wouldn't check it out at
you
all.
still got those loans.
They wouldn't check it out at all. So you have this Fair Housing Act that gets put in place in the late 70s, and ultimately it remained relatively small through the 80s, because when Reagan came into office, he simply did not allow for the expansion of it. Banks only had to write so many loans to people that were otherwise not qualified for those loans. And then Bush kept that same stance. This is Bush Senior. He kept that same stance for the 4 years that he was president. And then Bill Clinton comes into office, and Bill Clinton did a 4 or 5 times expansion of the Fair Housing Act. And this was done quietly, because what was making the news at the time was, number one, Bill Clinton had an intern that he was having sex with. Number two, Hillary Care, the first, the precursor to Obamacare, was such a disaster that it couldn't even get passed through a Democrat House of Representatives. Number three, Bill Clinton in the midterms, after getting shellacked in the midterms, he pivoted and did crime legislation. He did welfare legislation. He did some very conservative, or at least middle of the road things. And that was all the news. It very quietly slid under the radar, this massive, massive expansion of the Fair Housing Act. And we are talking massive expansion of it. Fast forward from there to 2008, and so many banks had so many bad loans out there to people who did not qualify for those loans, that when the housing collapse took place, anyone who had paid attention to what was going on for the previous 20 years would have looked at that and said, it's about time. It's probably overdue. Probably should have happened 5 or 6 years before. Surprised it didn't happen 5 or 6 years before. So again, fast forward a little bit. Ultimately, that led to what's your favorite piece of legislation, Kevin, that came in 2009? Your very favorite piece of legislation in the history of the country?
Oh, the Patriot Act.
No. What's your favorite piece of legislation that screwed up bank regulation and trading and being a registered investment?
Well, that's linked to the Patriot Act. The 1,600 pages.
Dodd-Frank. Come on, man, get with the program. Dodd-Frank. You bitched to me about Dodd-Frank nonstop.
Yeah, so Dodd-Frank was a little bit after that, but yes. Okay, so I'm on board with you now. So let me complain about
I'm off a little bit on the
Dodd-Frank.
year, but you complain nonstop to me about Dodd-Frank, and I don't argue with you, because I'm on the same page. I complain about it as well.
So here we go.
Let
me throw this out.
From that housing collapse and from that government bailout came the Dodd-Frank Act, which allegedly should have prevented a situation like this SVB Bank. Kevin, why didn't it?
Because it's not enforced. And let me actually take that back. It's not enforced on the level that it needs to be for the big guys. For me, it gives me 40 extra hours a month of work I have to do that, I'm just going to say it, that I don't have enough money to go take my legislation out to the strip clubs and to buy them all the drinks and the yachts with the hookers where they'll overlook me. They'll search my stuff and put a fine tooth pencil to everything. The bigger guys get away with it because in all essence they get bought off.
Because SVB, who should be firmly in that category of banks who could not get away with what they have done, is in bed with all of Silicon Valley. They're out financing every venture capital opportunity that comes up. They're out schmoozing all of the powerful lobbyists for Google, for Apple, for Amazon, for you name it. Name a tech company out in Silicon Valley, and chances are SVB has been schmoozing them along, and then they in turn, Google and Apple and Amazon, all these big, massive companies, massive tech companies out in Silicon Valley, they then go out and schmooze the regulators who are supposed to be monitoring what's going on at banks like this. And they look the other way when a bank is obviously doing things that are putting their customers in jeopardy. They're out there creating a crazy, ridiculous balance sheet that has two major flaws in it. Number one, that the biggest flaw they have in that balance sheet, I believe, is too much venture capital or loan lending. And number two, they got way lopsided and heavy on long-term bonds that have been crushed with rising interest rates, with rising inflation.
Yeah, you nailed it. I mean, you nailed it 100%.
And if the regulators would not have been intentionally turning the other direction, if they would have been doing their job and looking at what SVB was doing, they would have picked up on this and said, "Hey guys, you're really getting a poorly balanced, a poorly allocated balance sheet. You're all screwed up here. It's going to take one little chink in the armor, and that is rising interest rates, courtesy of this guy in the Fed. It's going to take just a little bit of rising interest rates for you to get absolutely crushed because of the way your balance sheet is allocated. And instead, they're turning a blind eye to it because these guys are in bed with all of the big multi-trillion-dollar companies in Silicon Valley who are saying, "Hey, don't worry about SVB. They keep giving us money for every little pet project we want. Every little venture capital thing that we want to have a hand in, they keep giving us money for, so leave them alone."
I'm surprised their unsecured loans weren't also in crypto and the coin-based garbage. It's shocking.
Well, I did hear that there also was a little too much exposure in crypto, just maybe not as much as what people would assign a huge red flag to. Any exposure in crypto is excessive in my opinion, because I'm on the side of crypto being fool's gold.
It's high risk.
There's nothing to it. There's nothing backing it. There's nothing. Now, I guess because we don't live by the gold standard anymore, technically speaking, there's nothing backing the US dollar either. So maybe I have to rethink a little bit on that being the reason I don't like it. But anyways, well, let's not, we'll save a conversation for crypto at another time. Let's talk about the rest of this week, because we've got maybe 10 more minutes to go here. Tomorrow, let me bring up the financial calendar. That's just the easy one that I like to pull up here. Give me 1 second. Probably should have had this pulled up already, but let's get our economic calendar up here. And tomorrow, this is going to be the big granddaddy. I mean, already, I don't know if you saw it on the other page I was on just before this. Let me go back to it for 1 second here, because it'll kind of set the stage. Read what I've got up here at the top of the page. 85% probability of a 25 basis point rate increase on March 22nd when they announced that. The other 15% is probably leaning heavily towards this being 50 basis point, with only a little bit of it leaning towards zero rate increase. But isn't all that just an exercise in futility right now today? Because I think it's all coming down to this. Am I wrong on that?
No.
I mean, at the
Although,
end of the day, CPI numbers, when they get released tomorrow morning, 8:30 a.m. Eastern time, 6:30 in the morning our time, Kevin. Um, that's the news of the week. I mean, whatever happened today and however schizophrenic the market might have been today, the simple reality is this is what everybody, and I mean literally everybody in this country right now, people in the market, people not in the market, this is what everyone is thinking about. This is what everyone is concerned about. This is what everybody feels every time they go out to the store, every time they drive across town or take public transit, every time. Come on, are you kidding me? Who the crap put that number up on there? It is like 170%, not 30%. Maybe I grabbed a screenshot of an old chart. That's absolute BS. That's not even close. This is probably more like 50% up. This is more like 100% up. This is more like 100% up. So these numbers right here aren't even an accurate depiction, but this is what everyone, and I mean everyone, is focused on right now.
yep.
What is going to happen with the consumer price index? Is it going to be higher than projected? Is it going to be lower than projected? Is it going to come in about where it's projected? I mean, what's your prediction on it tomorrow, Kevin? Let me click on this, and this takes a second to refresh. But and I know for people watching this later on, these numbers aren't going to be real big on your screen. The consensus is that we're going to be up 0.4% month over month, 6% year over year. That's the consensus. What do you think
Correct.
is
Yeah,
going to happen, Kevin?
briefing is already saying it's going to be 0.5. Last month was 0.5. Gas prices and energy are going up. Watch it be 0.6. I don't see how it can be 0.4 when I look at what's in that report and what's going up in price. I just don't see it. I think it's going to be higher, obviously. I don't even think it's going to be 0.5. Watch it be 0.6 and watch the market just be in deep trouble tomorrow.
I feel very similar about the year over year number. Last month it was 6.4. That was surprisingly high. They're projecting 6. I'm telling you right now, I think it will be 6.4 or 6.5 year over year.
Yeah, I think it goes higher. And then we're going to
I
follow
think that I
PPI
think that
tomorrow
6 is going to
or
be way off the
Wednesday,
mark.
excuse me. Wednesday PPI is going to be higher. How can we not be setting up for a bloodbath?
And regardless of what is happening, I mean, regardless of what's happening with this bank and with this meltdown and how it caused the market to be so crazy. See, this is really, in my opinion, ridiculous. Last month on the PPI, we were at 0.7% month over month. The projection is 3. Give me a break. I got to believe that's going to be way off on Wednesday.
Definitely.
I think the PPI estimates are a little bit soft. The CPI. I think the consumer price indexes are a little bit soft. I think the producer price indexes, I think that's a very, very soft estimate. Both of these numbers right here, year over year and month over month, I predict this is going to be 0.7% or higher, and I predict this is going to be 6.2 or higher.
It should be. And I mean, we'll get it 2 days in a row where
Double whammy.
watch the Fed have to raise it 50 basis points. And with all reality, watch regional banks be in huge trouble Wednesday, Thursday, Friday, and there'll be more talks of bailout because
Now,
that's what we do.
I don't think this is likely, but what happens on March 22nd if the CPI number came in a little bit hot and the PPI number came in down around these projections. I think that's unlikely that it happens that way, but let's do a what if for just a minute and then we'll wrap things up. What if one of these comes in a little bit hot and one of them comes in a little bit soft?
I feel they still have to raise it
I think
because
the
they don't
25
have
basis point,
control over it.
I think what that would do is probably lock in the 25 basis point hike. If both numbers are high, I think you'll see it shift to a probability of a 50 basis point hike. If by
Yeah.
some miracle of a chance, and I'll be very suspicious of manipulating these numbers, if by chance both of these numbers come in a little bit soft, I think between now and the 22nd, you're going to have a week and a day or two of kind of a strong rally in the markets. And then Powell's going to surprise everyone by sticking with 25 basis points instead of going to zero. And the day after the 22nd, or the day of the 22nd, you're going to see the next big drop, the next big leg down.
Yeah, I mean, so here's the question. Are we in a bullish market right now or a bearish market?
We're in a flat market. We're in a very volatile flat market. I mean, let's be honest. Since there's January 1 right there, it's been very volatile, but we're basically back to, I mean, it might not be exact, but we're, for all intents and purposes, we're back to a break even right now. But it's been volatile. Even these couple of little dips. I mean, that's if you draw just a more straight line on all of this, that's, that looks like the view out my window of the Rocky Mountains. That's up and down and up and down. And look, this,
Head and shoulders.
people ought to be worried not only by this downward trend, but by each successive day of that slide, more volume. That tells me we're setting up for a breakthrough this support on the S&P that's right here in that neighborhood of 38.25. I'm ballparking that number. That's not exact, but the volume increasing each of these successive days down tells me that if the CPI numbers come in hot tomorrow, you're probably at a bare minimum, you're breaking down below 3,800 on the S&P. And if the PPI numbers come in hot, watch out for this next moderate level of support down here at 37.25. And Kevin, is it feasible that before the end of March, we test the October lows again?
Definitely. I mean, I think you asked me this about 3 or 4 weeks ago. To me, I could really see us touching 3,600. There are some calls for 33 to 3,200, which seemed a little out of place. They seem more in place right now. If we're losing regional banking because of a poorly run balance sheet, we've got some waves going to trickle through our market that are going to have some devastating consequences to our GDP.
Yeah, you're at a point now right now where you're going to start to get some ripple effect in one more shoe drop, one more thing affects the next thing, and I think that's well on its way. Any final thoughts to wrap up? I'm telling members of Safe Option Strategies, don't do any trade that is purely directional bearish or directional bullish. No matter how much I think we should be back down here testing lows, the reality is soft numbers on the CPI and the PPI, and we could rally back up in this neighborhood before the 22nd. Easily, we could easily be back at 4,100 S&P if you get some soft numbers on CPI and PPI. If you get some hard numbers, if it's trending back in the way that people don't want it to trend, I think by the time we get to that rate increase, we could be back down here around 3,575, 3,600 on the S&P. So
I know you're trying to finish up, but tell me what would give us softer than expected numbers on CPI and PPI?
Well, I don't think. Well, I told you if those numbers did come in soft, I'm going to be a little suspect of them. But I, so I can't tell you. I don't think that's what's going to happen. I'm out of the business of trying to predict what's going to happen. I was surprised at the end of last year after the inflation numbers peaked at 9%. around, what was it, June or July that it sort of peaked around 9. I was surprised that it started to back off a little bit. Now, it didn't reverse and come down. It just, instead of going up this fast, it was only going up this fast. So it was still, prices were still going up. They just weren't going up as fast. But it shocked me that this happened. I thought we were going to get double-digit inflation. I thought we were going to go over 10%. So I can't predict why those numbers would be smaller. Everything around
So
me, everything I see suggests to me that they should be higher than they are right now.
let me run through what those numbers are based off of real quickly. Food and beverages, and I still see food up high. Housing. Housing looked like it was dipping, but it seems like it's heading back up. Equivalent rent, which they now tweaked because so many people can't afford houses, right? But rents are still high. Apparel, transportation, vehicles, motor fuel, medical care, education, communications, special indices, core energy services. Out of that list of things that are, how do I say it? Out of the list of those things that are defining our CPI, I don't see that break in. There's nothing there that tells me, oh yeah, we're going to come back down.
That it should be easing off.
If anything, those items have been more expensive here recently.
Let me add one thought into that. After we got a little bit of a break, a little bit of breathing room on gas prices, because Biden tapped the strategic oil reserve and just I think what he did was criminal and ought to have him impeached and in jail for doing that. That's unprecedented what he did to buy votes with that. Gas prices, we got some reprieve for a little while, and then they have steadily begun climbing back up. In my area, your area, Kevin, we're back up to almost $4 a gallon. We got a reprieve down to, did it get down to $2.90 or so at Costco gas at one time? And now we're back up to
$3. If it was at $2.90,
now we're back up to $3.90. We're back up to $3.90, almost $4. When the price of gasoline and diesel go up, the price of everything goes up, because nothing arrives at your door, nothing arrives in your local grocery store, nothing is delivered to you in any way, shape, or form that does not take fuel. Even if it gets out here on a coal-powered train, which I don't really think they do anymore, even if it got out to your area on a coal-powered train, you still got to put it on trucks to get it to the store. You still got to put it on trucks to get it to the train yards. Nothing moves around this country without gas and oil. So when those gas and oil prices go back up, and they've been steadily going back up since the start of this year, it's inevitable that it starts affecting the price of goods at the store and the Amazon things that are delivered to your door and so forth. So if you want to simplify it a little bit, there's no other reason you need for probably these numbers being really soft on the estimate side, and the numbers we get tomorrow probably being higher, because the price of gasoline is back on the rise and shows no sign of stopping
at all.
Okay, we probably better wrap it up there, Kevin. Any closing thoughts?
I'm just looking at the future for ending in March. I don't see how we don't test those lows. I mean, I'm putting protection on my stock ownership, and I'm also putting SPY puts in portfolios just to give us a slight hedge to the downside. Like you, I wouldn't go all in one direction. That's not smart investing, but I definitely am hedging to the downside through the month of March. In fact, really through our April 18th, turning our taxes, because we're going to have some tax selling going on as well.
I'm not recommending to anyone at Safe Option Strategies that if they want to do any type of a spread trade, any type of an option trade, that they play it strictly non-directional, because I think we could just as my gut tells me we're in for more downward trend. But again, if those numbers came in softer than expected, this market's going to rally back up, and it's going to do so in a strong way. at least temporarily until that next rate hike comes. So anything in the way of an options play, I'm playing completely non-directional. And most of what we do at Safe Option Strategy is collar trading, where we're rarely, if ever, without long puts in place. And man, we're going to have some phenomenal returns on collar trades this year. So yeah, stay hedged. I agree with what you said. Stay hedged. I think it's likely that by the end of this month, at the least, we're testing this mark on the S&P. We might test this this 1 day touchdown low down here around 3,500. I would not be surprised at all if the S&P gets a test of that before the month is over.
And Jeff, I know I'm saying that going against our technical crowd because we're pretty close to being oversold on the S&P 500. But man, I personally just don't see it. I don't see that technical bounce with people buying into the market because it's cheap with all the bad news we have built in for the month of March. I just don't see it.
Yeah, and I've been telling people for months now, until there is a change in economic policy, which is not coming anytime soon, until there's a change in economic policy, the underlying fundamentals of the economy are such that we should be trading down in this area right now, not talking about will it come back down here. This was all a house of cards. This was all a house of cards. I mean, you can't deny the fact that it happened, but it went against rationale, it went against logic, it went against fundamentals, and it can't keep doing that indefinitely. You can't have a market that keeps going against the fundamentals of the economy for long periods of time. Eventually, it is going to catch up with you, and I think it's going to crash hard before this year is over.
Could crash hard the next 2 weeks.
Could happen. All right. Probably better wrap up right there.
Sounds good. Appreciate you guys being with us today. Look forward to seeing you next week. And Jeffrey, you have a great week.
Thanks.